Hey everyone, welcome to another episode of Punch Card Investing, and the gang's all here. What a wonderful time to be alive. Good to see you guys. It's been a couple weeks since I've been here, thanks to a couple weddings. I have 8 weddings this summer, and I've been through 5 already, so 3 more to go. And in the last 8 days, or up until last week, I had 3 weddings in 8 days, or something like that, and that was pretty intense. So that's behind me now. Just a few more weddings to go. But good to be back in the punch card investing sphere because it's a lot of fun here because we have a very fun topic that we actually did in our inaugural episode, and that's going over our best investment ideas because that is always a change. Well, not always a changing thing, but often is a changing thing. The investing environment changes, different ideas come to the surface. So always good to give updates on that. And I think we're going to make this into a quarterly series where every 3 months or so we'll do a new best investment idea, see what's changed, if anything's changed, and also kind of review maybe some of our past ideas to see how they've fared in the last quarter. So, anyways, does anyone want to volunteer and go first? Kron, why don't you and I go first since we're on the same page again?
Yeah, we pretty much have the same portfolio, don't we?
Yeah,
Pershing being our top holding,
So
and equity Commonwealth.
Who's cloning who?
I would say I cloned Karan months ago when he planted the idea of, hey, if you're interested in Pershing Square Taunting Holdings, take a look at Pershing Square, the hedge fund, because they get a lot of the icing on the cake there, assuming everything goes through. So, and that was months ago. So that's what first turned me on to it. So thank you, Karan.
Yeah, so with Pershing, we're taking it not even like beyond cloning, we're just directly investing with Bill Ackman. So that's pretty much what you get with Pershing Square funds, is that Bill Ackman is allocating capital. And yes, there is a fee that is charged. So that might be something that puts off a lot of people. But what you're getting for that fee is all the SPACs that he's been able to come up with. And part of that is the UMG deal that we've heard about. And that was them basically using $4 billion from Pershing Square Taunting Holdings to go out and buy 10% of UMG. So that's something that happened recently in Pershing Square Tontine, but it also impacts Pershing Square funds. So
what's weird about Pershing is it's since our last episode, it's basically gone sideways. The actual hedge fund, not the SPAC. The SPAC's actually gone downwards. Tontine has gone down since we last talked about it, or since we last did this best ideas episode. But to me, the thesis seems a lot stronger now, in that there's less uncertainty with Pershing Square Taunting Holdings. But it's not completely absolved of uncertainty since there's some SEC things that we have to get through. But a lot of the same catalysts from before are still there. Only this time there's some more clarity. You know, you're getting into UMG and it's at a seemingly attractive price. And also you have all the extra liquidity through the Spark and then the RemainCo that come with the SPAC. So I like it more than I did 3 months ago. Not a ton more, because that was kind of to be expected somewhat. But it's removed a lot of uncertainty that was there before. So I like it more than I did before. I don't know about you, Karan. Have you increased your conviction on it?
Slightly, yeah. I did allocate more of the public portfolio to it, around 2.5% of the portfolio more. So now it's around 17.5% of the total portfolio.
Coincidentally, that's around where my stock portfolio is at. It's 16.5% or something like that. So,
yeah.
Go for it.
Even 6 months ago, like that was the same idea. So Pershing Square Taunting Holdings could go back down to NAV, but Pershing Square funds already are trading at a discount to NAV of around 25 to 30%. So, but that's going to persist. I think that's going to persist for a while, because apparently you need to be trading at a discount to NAV to be listed on the Amsterdam Euronext exchange process, right? So yeah, I mean, there's always a better upside and less of a risk with the Pershing Square funds.
But even with because of what's happened at Taunting Holdings, I think that could be a pretty attractive play too. If you're not interested in the full Pershing Square fund for whatever reason, whether it be fees or it's just harder to access because it's not in like the U.S. markets or something like that. Pershing Square Taunting Holdings is getting increasingly attractive since you have the redeemable right at $20 per share to get cash back. So that theoretically is the floor, though who knows what could happen beyond that. But it seems like your downside's limited there, and it's trading at something like $21 a share now. So you got basically a 5% on the negative worst case scenario, theoretically, of course. Who knows what the future really holds, but you have your downside protection there, and then you have the upside of the UMG deal if that goes through. If you believe that you're getting UMG at a discount, then you also get the right in Remainco and Spark. So the SPAC itself, given the price it's at now, is still pretty attractive. I would still rank Pershing Square Holdings, the fund, ahead of it, but for someone who doesn't want to get into that, that's definitely something to look into right now.
I think there is a bit of an Ackman discount also priced into the Pershing Square funds because a lot of people just, I guess, don't want to be invested with Bill Ackman. So
if that was true, though, then I just don't understand why Pershing Square Tontine ran up to such a premium. Like a couple months ago, I think it was at like $28 a share, so well above its like redeemable right value of $20. So there was a premium there for sure, and that quickly evaporated with many of the SPAC pullbacks we saw in recent months. But it seems weird that he'd command such a big premium there, but not on the fund, his normal fund.
I think even Brad was in it, right? Yeah.
Yeah, I owned Pershing Square Tontine for a little bit. I mean, it seemed like the whole SPAC space really, there's a lot of interest in it for a little bit there, and then it calmed down a bit. So
it did.
It doesn't correlate that much. Doesn't seem like to Pershing Square Holdings when you look at it. It's more kind of locally what's happening with investor sentiment as a whole.
I think that's a fair take. Tom and Frank, have you guys considered or have you invested in any of the Pershing products?
I personally haven't invested. I'm more interested in UMG or the Pershing Square Tontine Holdings more so than the holding company. From what I've seen, I think there's a lot of value there. And I think the discount to Pershing Square, is it part of your thesis that that's going to go away? Because in my mind, I don't see that discount shrinking at all, or that's irrelevant to your thesis.
It could shrink a little bit, but it's not that relevant. What Karan and I see, correct me if I'm wrong, Karan, is the asset value itself will go up significantly once the Remainco gets active. They have all their warrants there. They have the Spark rights as well, which would lead to future deals as well. They have a lot of liquidity to do future deals, and that's where we see a lot of the upside. Plus, has a pretty good track record thus far, just with more quote unquote conventional investing beyond just the SPAC deal. This is only one part of the greater fund.
What percentage of the fund is it? Do you know?
Well, it depends on how you look at it. Karan, you're on top of the numbers with like the Spark, the maximum like Spark rights they could raise.
What exactly are you talking about? Pershing Square Tontine or?
Yeah, how much does the Tontine Holdings make up out of the overall holding company?
So Tontine is now split into two parts. So the UMG portion is 1.6 billion of the total fund. So total equity portfolio value is around, I think, 12 billion, if I'm not mistaken. So 1.6 of that goes to UMG. There's another 1.4 in PSTH, and also Spark has commitments. So it's not, the money's not there upfront, but it could be anywhere between 1 to 5 billion.
So overall, you're looking at about 10 to 15% of the overall fund. Is that right? Roughly, just give or take.
Yeah, it'll depend, but yeah.
If you just see this cash, it's almost 50%. Potential cash, it comes to almost, because it's almost half the entire fund that could be invested in the future.
Yeah, okay. And so what about the rest of the fund? How do you feel about the other positions that he holds? I haven't looked in a while, but I remember being not too overly excited when I looked at his portfolio.
I don't think it would fit your thesis, Frank, since you're looking more towards like micro caps, and the fund is generally larger cap companies at the moment. Like they just traded out of Starbucks into Domino's, which is another big brand. So I don't think you have like massive compounding opportunities within the current portfolio, maybe with Howard Hughes. But like with a lot of the core kind of names they have in there, I don't see it. You're not going to get like a 100 bagger anytime soon with like restaurant brands or something like that. That's already kind of a mature company. Though who knows?
I think the difference with the companies that are there in the portfolio, the difference is that Ackman himself is on the board of, like, say, Chipotle, and he can make an impact when it comes to, if he sees management going off somewhere, he can come in and step in and, kind of make changes. So I think that is something that maybe is not accounted for as much.
It's hard
But
to
I find that
value.
it's an advantage. Yeah.
Yeah.
So I can just quick throw out what they own in terms of public companies. Lowe's is the biggest, then Chipotle, Hilton, Restaurant Brands, Agilent Technologies, Howard Hughes, Domino's Pizza. Those are the bigger positions. So, I mean, a lot of these are great long-term compounders, but the problem is they're to the point where everyone knows that they're
Right.
long-term compounders. So it really cuts into that potential.
Exactly. He tries to, in a similar way to Buffett, Buffett's not doing micro caps or anything like that, or not regularly at least. He's looking for good, predictable, strong businesses. Maybe they're past that first exponential part of the curve, but if you can get it at a good price, like with Domino's, they're already up like 20 something % on it based on their cost basis. Buying a good business at a good price is kind of the general thesis. But then, like Karan was saying, if there's a chance to provide some activism, provide some value otherwise through management or creating a spin-off or whatever it is, that's kind of where his extra oomph comes from. Like with Restaurant Brands and Tim Hortons, for example, that sure, Restaurant Brands is already big, but he created a new opportunity there with the Tim Hortons spin-off and also helped turn around Chipotle, and that's been a big run up, even though it was already a pretty large company. So that's kind of where some of the opportunity comes from. But of course, that's not always super reliable, depending on what sort of company he's getting into.
Do you guys see some risk in some of those holdings? Like Chipotle, I just looked it up, has run a lot. It's like 110 times earnings at the moment. How do you guys think about that and the overall portfolio?
Chipotle is only in the US for now, right? It's not got any international presence.
As far as I know, yeah. It's just US.
Yeah.
40 international restaurants.
that right?
I just saw that on ticker. Yeah.
I didn't even realize that.
2,700 in the States and 40 international. So pretty much just in the States.
Is it just in one country? Does it say?
Doesn't say.
I'd be curious where it is. Maybe it's Canada or something. Canada or Mexico.
Right.
But I was feeling that way, Tom, about Starbucks, since it had a very similar run up very recently, like post-pandemic, even though like their stores haven't been doing great because no stores have been doing that great in the last year. I mean, they're starting to recover now, but it ran up as though it was already recovered. And I think that's one reason he wasn't hesitant to sell it off, even though it is a great business, and then spun it into Domino's.
It's all those levered buybacks Starbucks are doing, right?
Yeah, right. Maybe.
Yeah, it looks like Canada and London they're in.
Okay. Interesting that they are trying to get into the European market. I wonder where that will go. That could be the big growth opportunity for Chipotle, being only US so far. So maybe it is a compounder still.
They do have pricing power, Sandeep mentions, yeah. Yeah, I mean, recently they raised the minimum wage, and they said, yeah, we're just going to pass on the cost to the customers. And that's it.
I think pretty much all restaurants will follow suit. I mean, if I'm not mistaken, McDonald's did the same thing, seeing as though they're closely tied. So,
I think Monish Pabrai mentioned Chipotle at some point, how there's always a line, and that's been my experience as well. It's crazy. It's just like they're just printing money over there.
It's a religion for some people.
Yeah.
What about you, Brad? What's your best idea of this quarter?
Yeah, so what I did for this, there's nothing I'm actively buying at the moment, so I decided to do a little work for you guys. I went into MOI, and there was just a wide moat conference, sort of a best ideas conference based on wide moats. And I watched 5 presentations for companies that were under $1 billion market cap. And the one in the US that is actually somewhat compelling is FRP Holdings. It's like a $500 million market cap. I'm going to send you, Frank, the link so you can, I don't know, is it easy enough to pop up for people if I send it to you in the private chat?
Yeah, go ahead, Brad. I'll pull it up.
All right. There it is. So what is FRP? So they have basically two big segments. One is they run gravel pits. Okay, they own these gravel pits. They don't actually operate the gravel pits. They earn a royalty on the gravel pits. And one interesting thing about aggregates, which is kind of the industry term for gravel pits, Peter Lynch actually talked about gravel pits in One Up on Wall Street. He said, if you've got the only gravel pit in Brooklyn, you've got a virtual monopoly. Plus the added protection of the unpopularity of rock pits, right? The whole idea of NIMBY. If you have a mine, like, it's really hard to get other mines up and running because nobody wants them in their backyard. And the thing about gravel pits, how far can you actually truck gravel in a cost-effective way? You can't. So if you're the only gravel pit in like a 50-mile radius, you have a monopoly. So that's one aspect of their business.
How significant is that within the portfolio?
What percentage of their total value does it make up?
Yeah, or just approximately. Like, is it a quarter, half?
It's
most?
about a third of their value, of their net asset value.
And
So
how many properties is it? Is it just these on the site, or are there others?
they have about 9 multifamily properties, and then they have a bunch of land properties.
So like this Hyde Park thing right here. This would be an example of the land they own.
Right.
And here's like a multi-unit complex.
Yep.
Gotcha.
So the other big one is the multifamily that they own in Washington, D.C. And it's, right along the river. I don't know how many of you have been to D.C. I haven't been to D.C.
I actually have not.
Okay. But they have 7 multifamily sites near Amazon second headquarters in D.C. And these are Class A riverfront multifamily properties. There's some that are, fully occupied. There's some that are still being developed. But the estimate for those is, it's about $300 million for net asset value for the multifamily properties, about $250 million for the aggregate. Now, one of the really interesting things about the gravel pits, one of these gravel pits is 100 acres in Fort Myers, Florida. Okay. And so they have this company, Vulcan, basically, mining the gravel for them. And their plan is, when the pit has been dug, the beautiful thing about this area in Fort Myers is that it turns into a lake. Okay. So now they have 100 acres of lakefront properties. So Vulcan is paying them to dig them a lake, to have lakefront properties. So, 2028, the plan is to sell, 100 1-acre properties in Fort Myers for, like $50 million or $150 million. So that was kind of a funny nuance. But so it looks like, the current share price is around $59. It looks like the net asset value is somewhere around $81 per share. So there's about a 30% margin of safety.
And is that assuming those like developments along the lake go through, or are you factoring kind of the future value, or just currently?
No, that's current value.
That's an idea right there, ladies and gentlemen. Good find, Brad. I want to look into that more.
It's interesting. I think, especially for those of us who own Seritage, it's got some has similar qualities.
Elements. Yeah, but not quite as cumbersome to work through.
Exactly. You don't have to look up 170 properties and try to figure out what they're worth.
The lakefront, or create a lakefront property.
It just kind of blew my mind a little bit.
That's interesting. Like, you're theoretically saving on development costs if they're digging a hole for you. Though I wonder. I'm sure they're not just filling it with water right then. There's got to be some sort of like remediation after that. I don't know what that looks like, but certainly
I don't know. I don't know the details of that.
I love this one, Brad.
And the CEO owns 15%, so it's got a pretty heavy insider ownership aspect as well. And in 2020, it was quite a bit cheaper, and management was buying back shares at about half of NAV. So there's that, shareholder orientation that management clearly has.
Yeah. Where did you say you found this again? It was MOI?
Yeah, Manual of Ideas conference.
Has a lot of similarities to Blackstone Minerals that I was looking at as well, where they really don't have any capital expenditures. It sounds like they're turning most revenues into free cash flow, at least for the past few years. Looking on ticker, they've been able to do that anyway.
Yeah, it's funny. They actually they had a warehouse portfolio that they sold to Blackstone in 2018. I guess, the warehouse market was getting a little frothy.
Oh, it still is. Yeah.
They didn't have any trouble parting with that asset.
So I forget if you mentioned it, but did they have significant debt? I'd imagine not if they just sold off a bunch.
No, management, they really prefer low leverage. So on some of their properties, they did, I think it was like a 12-year, 3%, real estate loan.
Sure.
So
probably be fixed for a few years from here.
Bring on the inflation, right?
Yeah, right. You got a few years of a window. Usually it's like a 5-year term or something like that before it's adjustable. Usually is how it'd be. But
yeah, I'm not sure about this one.
Yeah, but as long as they're not like extremely leveraged at their ears, like that's an attractive one.
Yeah, they're pretty conservative with leverage, it seems.
Yeah. And it's almost like the reverse of what like Equity Commonwealth's doing. It's one of Karan and I's other holdings that we share, and that they are trying to buy industrial right now after selling off a bunch of office. Whereas in this case, these guys are selling industrial, holding on to their multifamily and quarries, apparently, land.
But it did remind me a bit of Zell in terms of being willing to sell at a favorable price.
That's what I was thinking too.
Yeah. So I did see that.
Yeah, Equity Commonwealth is actually fighting for deals because they have a rival bid that's come up for Monmouth, and that's higher than what they're willing to pay. So clearly the market is overheated when it comes to industrial.
Yeah, because it's not like Zell was getting a massive discount on that deal. So someone's trying to come in even higher after they've already committed. And that would trigger like a breakup fee and everything. Go check out Karan's video he recently released on Equity Commonwealth if you guys are interested. After this live stream's over, of course.
That's right. Stick around, people. Stick around.
All right. I love that one, Brad. You guys have any other thoughts, or move on to another great idea and then we can keep going from there? Tom, how about you?
Yeah, sure. Yeah, I don't know if we're about to move on to a great idea because I don't have many at the moment.
Okay. Did I say great? I meant to say best, and best can still be bad.
It's the best of all my mediocre ideas at the moment. So,
real quick, Jack, I'm going to send you a quick image of that man-made lake just so you can kind of get
I was looking on their site. Here, hold that thought, Tom.
No worries.
And here we go. Wow, so this is out of a quarry?
Yeah.
That's nuts.
It's a real sales pitch shot, isn't it?
Oh, yeah. That's pretty neat, though.
We should do a live stream there.
Yeah. But we're officially monetized now, and after we save up for a few years,
I think we made like $6 in ad revenue this week, so we could go over there and have a punch card conference.
Yeah, that's like one drink between all of us.
We could buy a beer and split it.
Yeah.
Yeah. Just water it down a bit.
All right, I love it.
Go ahead, Tom.
All right, go for it, Tom.
Yeah, cool. So I think like all of us in this chat at the moment, and probably many other people in the comment section, I've been looking quite a bit at a certain Chinese e-commerce business recently, and part of that process was basically going through and trying to figure out the competitive landscape. So I was looking at Alibaba, obviously, as many of us have been doing. You guys did a good stream last week looking at Tencent through sort of the NASPAs and process lens. And then one of the other businesses that has come up, I guess, going through that process is actually JD.com. So I was interested in maybe giving some of my initial thoughts, and if anyone else has been looking at JD either directly or just trying to figure out how sort of Alibaba fits into the world? If you've come across anything interesting, kind of going through that exercise, I'd be keen to talk through that. So I guess with Alibaba, it often sort of just gets flippantly labeled as like the Amazon of China. And the deeper you sort of dig into Alibaba, the more you realize it's not really the Amazon of China, especially from a business model perspective. So like Taobao and Tmall, for example, which are the two kind of big dogs for Alibaba's e-commerce business, don't hold any inventory. They don't have any warehousing. They don't really own a lot of their logistics networks. They're sort of more just matchmaking between buyers and sellers on a lot of these platforms, and collecting fees either directly on Tmall or through advertising, almost like Google style in the case of Taobao. So it's not really an Amazon style business model, but JD.com is. So JD do own their own inventory, they do own the logistics networks, and they do own warehouses. So yeah, that's been one I've kind of been looking at. It's a very large business, like a lot of these Chinese e-commerce players. As a result of their business model, they have a lot lower margins, and they're kind of only just getting to profitability in the last couple of years. But at the same time, I guess one of the lessons from a business like, say, Costco, for example, is that low margins aren't necessarily a bad thing. It's more about, I think, having consistent margins over a long period of time. And just running some initial valuations on a business like JD.com, it comes out almost as cheap as Alibaba is kind of where I'm landing on it. It's a bit complex in trying to consider all the different subsidiaries and stuff that they own. Again, a lot like Alibaba. But I'm kind of getting to the point where, I'm kind of tossing up, do I just pick what I think is the best Chinese e-commerce player, which the way I'm currently thinking about that is Alibaba, or do I make some sort of basket bet even in China? Do I buy JD, Tencent, Baba, maybe even Pinduoduo, and kind of just buy the entire basket? Because if I look at the stocks, they're pretty much all have really fast growing underlying businesses, and all of the stocks are down quite a bit over the past few months. They're kind of all just been chucked into this same bucket. So that's sort of where I'm at with Chinese e-commerce in general, but JD.com has been an interesting one to kind of look into and figure out, because it is quite a different business model to Alibaba. And then the really tricky part with valuation of JD, I found, is just trying to figure out what sort of margins they might have over time. Alibaba has produced more consistent profits, I would say, over the past several years than JD. JD's got very thin margins, like I said, and if they can go from a 3% profit margin to a 5% profit margin, for example, that's a huge kind of like absolute change in their earnings. So that's a sort of a tricky one to work through, but it looks cheap is kind of where I'm at with it.
Brad, in your Baba research, did you look at JD at all?
Not too much, no. I'm just looking now on Twitter who's been talking about JD. It's becoming my favorite place.
Between Baba and JD, I think the biggest difference is the vertical integration that JD has, and then the approach that Baba has, where they invest with partners. So like when they were expanding logistics, they went into China logistics and invested in that company and grew it that way.
Well,
Baba just makes more sense. Yeah.
My question would be, if they're vertically integrated, why wouldn't their margin be better if they're doing things in-house more?
Because they're reinvesting in the business, right? To
I guess.
develop the chain.
But at some point,
it's much more capital intensive.
Right. But once you make the investment, I'd assume the margins would at least grow or not shrink anymore. What one would think, unless it's like really that much that they have to.
Well,
competition is there. Yeah.
Yeah, but if you think about it from like almost like a Walmart or Costco kind of business model, they're not making huge margins on the individual product sales, whereas a business like Alibaba isn't making money that way. They're making money from advertising and fees, and they don't have to outlay the capital, so you get much higher returns on equity and so on, and that kind of business. Yeah,
that's a good way to put it.
Also, one of the biggest changes that we're seeing is that, so I think, Tom, correct me if I'm wrong, but JD doesn't allow AliExpress payments, right? Or there's some block over there.
Alipay.
Alipay. Sorry, not AliExpress. Alipay.
I don't know. My understanding from talking to a friend who was based in China for a while is that almost everyone accepts both WeChat Pay and Alipay, with the odd exception. JD may be an exception, but I don't know the answer off the top of my head. Okay.
So what I've been coming across is that Taobao deals and WeChat or some subsidiary of Tencent's chat, now they're going to start working together because of the recent regulations that have come up, the antitrust. So that's actually been beneficial, where Alibaba and Tencent are actually starting to work together in a way. And
interesting.
JD is going to probably not benefit as much, because now you have the large companies actually coming together, and they might just start putting even more pressure on the margins of JD and Pinduoduo, possibly.
Yeah, and I guess with Alibaba, the one of almost like the free lottery ticket type things, or one of the big drivers for future growth is the cloud business as well, which I think JD does have some sort of cloud business, but it's minuscule compared to Alibaba.
Yeah, clearly, it's not a winner-take-all situation. Like, you can have multiple players in the cloud space. I think Brad also recently tweeted something about Ali Cloud.
I did.
Being larger. Yeah.
Go follow Brad on Twitter.
Did you do some digging into Ali Cloud?
Just kind of back of the napkin estimates for what it could be in 5 years based on kind of where it's been and what's unfolding there. Yeah, it's compelling. One thing I think of with JD is, Pabrai has talked about a number of times about how Tencent and Alibaba seem to have, they early on they had a lot of international backers, so there's that kind of investor friendliness that they have. Where I'm curious what you guys see around JD with that issue.
I don't know. I'm not super convinced that matters that much. Unless we're talking about returning capital to shareholders, then that kind of stuff becomes a lot more important.
Right.
I think
I don't know if anyone else has thoughts on that.
Sorry, go that comment, Jack. Pull it up.
Yeah, we were talking kind of about the payment system, and I thought we'd get Scotty's question here about Alibaba and financial services. Is that a big catalyst you see? So we were talking about it, so I thought we'd get the question in.
Yeah, Alipay is huge. Like, again, talking to a friend of mine, I just didn't realize quite how ingrained and how last century China makes a lot of the rest of the world look in the payment space. Like, my friend talked about taking her partner to a cafe, and he tried to give the owner cash to like pay for the drink he got, and the guy had to like go out the back and find where his cash was stored, because they just don't use it. And then there's homeless people on the street, like this person's kind of saying about selling products on the street. There's homeless people on the street that are begging, and they'll whip out their Alipay QR code to accept money from people. Like, it reminds me of how Pabrai, I think it was Pabrai, talked about India skipping landlines and going straight to mobile phones. It's sort of like China's skipped FPOS cards and credit cards and gone straight to mobile payment systems. So it's massive.
I think my main critique around JD.com is just, if we're looking at other Chinese competitors, Alibaba, Tencent, even Pinduoduo, it seems to be the least appealing of the big Chinese tech giants. And with margins like that in an ultra-competitive environment, I'd be pretty concerned that it's reaching a state of maturity. These margins aren't going to get much better. And with that competition, I think they're at some risk of those, with those low margins. But overall, I just think it's not quite as good as the other businesses that I'm looking at.
Just purely because of margins, Frank, or you think they'll struggle to grow as fast as well, or something?
Well, even if you're looking at things like cloud, like all the different markets that they're or the different areas that they're competing with those other companies are, they seem to be the lower end. So it's, if they can push through and actually take some market share in some of those different industries, then it could be more appealing. But I just don't think that they're capable of doing that. I think they're probably coming close to maturity. Just looking at their growth over the past 10 years, it seems to be slowing down, at least top line growth anyway. Whether or not they really are reinvesting more than I know and have a bit of an Amazon situation going on, maybe their bottom line grows faster. But yeah, I just think they could be slowing down faster than the Pinduoduos and Alibabas of China.
Yeah, for sure. I mean, obviously the other thing to kind of match with that is how does the price compare amongst all these different companies as well? Because maybe they are slower growing, but the price makes them an equally attractive investment, if that makes sense.
Yeah.
And I haven't
looked at the price too much, but yeah.
Yeah, I mean, I've been working pretty hard on Alibaba the last couple of months at this point, and I'm still sort of trying to figure out exactly what I think it's worth. It's not the easiest business to understand, and JD is almost as difficult. So,
well, Frank, what do you
the
got?
longer you hold it, the better you'll understand the company, right? So that's a legal thought.
Absolutely. I think I've got a good idea of the floor, but it's all the. I think I'm in the right ballpark, but like you say, it'll get better over time.
Frank, what do you got? Best idea?
So mine's probably no surprise to most people. Best idea has been for the past 2 years pretty much now is Kelly Partners Group, a micro cap in Australia worth about $150 million on a market cap basis. The main thesis relies around the CEO and founder, Brett Kelly, who owns about 50% of the company. And he's a bit of he loves Buffett. He's trying to do everything like Buffett did with Berkshire in lots of different ways. Obviously, a very different industry. He's only focusing on accounting so far. Looks like he might be expanding that out in the future. But at the moment, he owns, I think there's 22 accounting firms that they own at the moment. And it is a bit of a roll-up strategy in a fragmented market. Different than most roll-ups, though, he is only acquiring 51% of those companies, with the owners of that business keeping 49%. So de-risking a little bit in a sense that way. And he's buying these companies for about 4 times EBITDA, so extremely cheap. And then he does what's called a tuck-in acquisition. So he'll acquire the companies, but he'll take those accountants and put them into existing buildings pretty much. So it takes margins from about the industry average, which is about 19%. Kelly Partners Group's research suggests that it's actually lower than that, but anything I can come across says 19% as the average. But Kelly Partner has an EBITDA margin of 37 or 38%, I believe. So almost double the margins by that tuck-in acquisition. And their market share, so their total addressable market's about $12 billion of small and medium enterprise accounting firms. The broader total addressable market's closer to 20 billion, but 12 billion for what they're targeting, and they make up less than 1% of that at the moment. And it's very fragmented. A lot of people reaching a retirement age. The average price of these businesses go for less than 5 times EBITDA. So there's a lot of opportunities to just keep growing through acquisitions. And the risk would usually be capital allocation. If you don't have a great capital allocator controlling these acquisitions, it would be concerning, and that's how they can go wrong. But Brett Kelly seems to be doing everything right. I've held the company since about 91.5 cents roughly. It had about a 250% return. So it was a much better idea back then when I bought the company mid last year. So it was easy to say it was cheap at the time. It's certainly less cheap now. From my calculations, it's getting closer to fair value, maybe slightly under. But it's definitely, the longer I hold it, the more I research, the more commentary from Brett Kelly I hear. It seems like a very high quality business. So I think it's almost worth paying up for. If I didn't already own, like if it didn't make up 40% of my portfolio, it would still be a company I'd be interested in buying. It's just that I don't really want to add to a position when it's already half my portfolio. So there's a lot to like about it anyway.
I really like the incentives seem to be so much more powerful when the acquisitions they're making. They're allowing people to keep 49% of their share, so that they have a significant stake in their own business, depending on how it's exactly structured. But I bet that's a big key to some of their success post acquisition, is that it's not like you're acquiring people and they're all disgruntled and they're like, why keep trying to build this business? But they still have a significant cut in it as well, which I'm sure helps for productivity and everything within each little accounting business that they acquire.
So typically they're buying out usually a retiree, not always the case, but they'll buy someone completely out of the business and keep a young partner on as the 49% owner. So they're very incentivized to do well. Yeah.
I've done a bit of work looking at Kelly Partners, and I really wish we knew each other, Frank, when it was 90 cents a share, because I think it would have been a no-brainer at that time. I
investor would agree, I'd bet.
Yeah.
Frank, go ahead, Tom.
I just had a couple of questions for Frank. I've one of the cool things with KPG is they have this like owner's manual, just kind of like Berkshire Hathaway does. They have a shareholder owner's manual kind of thing. I had one question on that, and then a question on selling, actually. So the first question is, I think there's one of the things in the owner's manual is Brett Kelly intends to sell down his stake at some point from something like 50% to 40% ballpark. I was wondering if you had any thoughts, and like if Brett Kelly said anything about how long he intends to run this thing. Like, does he want to be Buffett at 90 years old still running KPG, or is he going to go off and do something else? And my other question was, like, at what point do you sell? Because it still doesn't look that expensive to me, but it's gone up a lot. So just interested to get your thoughts on that.
Okay, so as for Brett Kelly selling off, so far he's not doing that, but I think he's absolutely obsessed with this business, and the commentary you see from him, I think he will be in this until the day he dies, probably like the Buffett. I think as he sells off, he's more so just his entire net worth pretty much is tied up in this company. So if he is reaching that age where maybe he does step back a little bit, let some of the other younger people play more of a role and run the business, he would want some of that money to enjoy, and he's made a lot of money doing that already. So essentially his shares are worth about $70 million or so at this point, maybe a bit more. So I wouldn't be worried if he sold off even half of his shares. At this point, it's still a very small company. It's just freeing up, creating a bit more public float. So I don't think that's too concerning. And what was the other question about me selling?
Yeah, about you selling. And actually, I might just add a third one in here, if you don't mind. Was around, I think KPG have done some share buybacks as well, which they may have toned down a little bit now, but they were buying back shares at one point. And just how does the Brett Kelly ownership impact that? Because presumably at some point there's going to be no float left if they buy back enough shares.
So I think they're going to stop those buybacks to an extent. The goal was always to get back to 45 million shares, and they're at that now or very close to it. So I would say unless they become dramatically cheap for some reason or another, there will be less buybacks going forward, or if any at all. They're certainly reaching close to fair value in my mind. So ideally, I wouldn't like to see as many buybacks going forward. I'd probably just rather see that reinvested going towards acquisitions. And they're also trying to increase their dividends by 10% each year as well. So it might go that direction. And for me, this is probably a never sell in my mind. Or maybe when I retire or something. I think I'll hold this for a very long time. If Brett Kelly gets out, then I would definitely reassess a lot just to see who's kind of taking over that position. Otherwise, I can't see myself selling in the next 20 years at least anyway.
Yeah, fair enough. Well done. You smashed out of the park with that one. So
already.
Congratulations.
Everyone in the chat, after you congratulate Frank on the home run, definitely get those questions going. Someone actually asked about the debt situation with Kelly Partners.
Yeah, I was curious about that too. It looks like 27 million in debt. Can you tell us a little bit about that, Frank?
So what was the debt number you said?
27 million.
In net debt?
Yeah. No, total debt.
Okay, yeah, so a lot of their debt is tied up in different ways. So the actual overall holding company isn't liable to all of those debts. A lot of that debt is on the partner owners that they have. So the debt number is lower than kind of first glance, and they do use debt fairly well with these acquisitions and things and reinvesting in different ways in the company. So at first glance, debt does look like a problem, but in my mind, there's not much problem there at all. And
I just have one follow-up. Why do one of these firms want to partner with KPG? Is it because the owner-operator is retiring and they're ready to kind of cash out, or what's the big strategy there for?
Well, they're all just, it's a very fragmented industry, mostly of people reaching retirement age. Mm-hmm. There's not too much to offer from owning a small accounting company like that. They're not earning a whole heap of money.
Right.
So at some point they want to sell and get rid of it. And Kelly Partners Group can offer a reasonable price for that, although it's only 4 times EBITDA. That it's about what it's worth for their company. That's about a probably 12 to 15% EBITDA margin. It's worth less to them than it is to Kelly Partners when they take those margins up to 36% or so.
Plus, I'd imagine it's not like it's a super liquid market to sell your accounting practice. I'm thinking, like, in my own experience, like in the law field, typically it's passed off to a close connection or something like that, or someone who was at the firm. They buy you out within the firm. You're not like taking it to the open market, because then you're getting into securities issues. You can't like go and issue security on your own business unless you want to take it public and all that, or file whatever with the SEC or whatever regulatory body you're dealing with. So that's probably why they can get it.
It'd be very rare to get an offer for an accounting firm if it's a small business owner. Yeah.
Frank, I had a question regarding like the price that you bought in at, so 91 cents. Do you think that there might be a possibility of anchoring bias with respect to the price? Would you be willing to, say, buy in later at a higher price because you're already up almost 300%?
I think my main problem with ever buying more is that just the amount of the allocation in my portfolio. I don't think price is the problem right now. I still think it's a reasonable price. It's hard to say whether I would buy right now if I didn't already have such a bias towards a company, but I still think it's slightly on the cheap side, and the quality seems to be getting better and better. So I think if I had just come across Kelly Partners Group now, I'd still be very interested. But yeah, with the half of my portfolio being there, it's very unlikely I want to allocate more capital towards it.
Yeah, when it's raining gold, you know.
Thimble, right? Thimble.
Yeah. Jack, I see After Dinner Investors' suggestion about a best idea. You should do that next quarter, I think.
Where's that?
The most recent comments about some random house in Chicago.
Yeah, sort of. I'm 5 business days away from closing on a townhome in Chicago. So so we're almost there, and it should close. Seller was making some repairs, so I'll be having some content on that one coming up very soon. It's a I don't want any bad juju for making content on something before it closes, because that could you never know what can change between now and closing. So in any event, I'll be doing some content on that. But yes, that would be my best idea right now. I've slowed down stock purchases waiting for this one. So more to come soon.
And for those of you who missed the beginning, Jack and Karan talked about Pershing Square Holdings.
Yes.
So Jack, how many properties do you need to start your own REIT?
I mean, you could start with a 1. Like, if you just put a fund together and buy an expensive building somewhere.
Might not be very cost effective.
Yeah, it's like there's not much of a point. This is a huge complex. So yeah, but there's all sorts of different REITs. There's land REITs, mortgage REITs, farmland REITs. Like, you can get as niche as you want. Single family home REITs. So Lisa's party. Yeah, I don't know about that. It won't be open to the public.
Jack's a little partied out right now.
Yeah. You must have done a lot of brushing up on your dance moves these last few weeks as well.
Yeah, my wife and I are we're pretty decent, actually. You see, at our dorm, this is super niche. But our dorm. So I met her the second weekend of college, and in our freshman years, and we've been together ever since. And at our dorm, they had these like during the week, I think it was like Tuesdays or something. Tuesdays after everyone was done with class, they'd put on these like little dance like get-togethers, doing swing dancing, pretty much just only swing dancing. So I got to learn all that stuff, and we're actually pretty good. we did like a whole we did a whole choreographed dance for our wedding. Like we did a waltz to "Can't Help Falling in Love" by Elvis. So that was fun. So yeah, we're pretty good. I will say, for amateurs.
There you go.
What to see video footage at some point.
It is someone filmed it. I have it somewhere.
Yeah. Video evidence for it to happen.
Yeah, true. Let's get some questions and then maybe I'll pull it up if I have some time.
Also, while Jack,
real quick, Chicago is scary in some parts. In other parts, it's okay. But yes, 2/3 of the city is scary, but 1/3 is pretty good. So, anyways, thought I'd address that real quick.
There's a 13Fs question from After Dinner Investor.
Ooh,
Our main question there.
I want to see that one.
Yeah, everyone just bought Alibaba and that's it. That's all that happened. That's it.
All in on Baba.
Yep.
Trying to think what else.
There aren't too many deals in.
No, I think what's kind of captured the news in the financial world this past quarter has been cryptocurrency falling. I can't think of any other stock things going on.
So I think for investors that we typically like to follow, the concentrated value type investors probably won't be doing much.
Yeah,
but there's always a lot of activity from some of these larger hedge funds anyway. So there's always something to look at.
Michael Burry will have done something, I guarantee you.
Michael Burry will have turned over about 35 positions, I'm sure.
I'm looking forward to Guy Spears 13.
No, you're not.
Blank.
In 6 years' time when he finally buys something.
Right.
In 6 years' time, it'll look the same as it does now.
Do you guys think he would have gotten into Alibaba? Do you think?
If there's any change, I guess he's obviously looking into that, being so close with Manish, but
no. I'd be more interested in seeing what he would sell if he did buy it, because that's more interesting because he never sells. So what is sacrificed to get into Alibaba if he does get into it?
I think he might start selling like Micron, maybe, if he's still got that in there. Maybe even Twitter or something. Didn't he own a little bit of Google for a while? Or did I dream that?
I think he owned tiny amounts of Twitter and Google. Like they were real small positions that he added last year at some point.
Like less than, I think, 0.5% of the portfolio.
Yeah. I think it'll be a cold day in hell when he sells Ferrari or Berkshire, personally, but could be wrong. What else we got?
I'm scrolling up towards the top. We had a lot of discussion when we were talking about.
There was a question about iRobot.
Yeah,
Has anyone looked into iRobot?
No.
What is it?
Not me.
iRobot.
They're the little vacuum cleaners, eh?
Right.
Or not?
Yeah, it seemed like the main concern with iRobot was just how many Chinese competitors there are, coming out with products for much lower prices. That's my take on.
Isn't iRobot a movie with Will Smith, or am I?
That's what I always think of. That's what I always think.
Is that what it was called?
Well, who got the domain? That's the big question.
Yeah.
No way.
So what I'm hearing is that sorry, go ahead.
The vacuum. The vacuum got the domain.
Nice. Yeah. What I'm hearing is that international competition is going to make iRobot the modern Berkshire Hathaway, and we'll buy out that net, and that can be Punchcard Capital's vehicle forward.
Well, shoot! Now that you said it that way, I want to buy some iRobot.
No, you got to let it come down first, and then make an offer to the CEO. He cheats you out of an eighth, and then you just
where's Seabury when we need him?
Yeah.
No one heard that. Don't spoil our plans, everyone. Charlie Munger's 13F is delayed. Like, is he at the back end this year? I doubt he's doing anything
delayed
new.
meaning he submitted it like a week after the quarter was over last time, and so now he's slacking.
Behind.
Well,
I doubt he's going to do anything new.
He's made his one investment for the decade. So
yeah, right. How many more does he have? More decades.
Yeah.
Luis, Japan. That's Shinnikin. I believe that's the only thing Pabrai owns in Japan.
Yeah. How long ago? We're getting on, what, 6 months now since that? I feel like it's been kind of a while.
Time is weird, man.
Yeah.
Let me see if I can find something in Ticker about when he bought it. Talk amongst yourselves.
Here's a decent one. I think this goes to actually value investors in particular, or in more broadly. What do you think about Ted and Todd doing a little worse than the S&P throughout their time at Berkshire? Well, during higher growth periods, especially, value investors tend to lag. Berkshire tends to lag in general during high growth, but it's those down, kind of like immediately during and then after downturns is where they make that big, what's it called? The premium over the market. That's
when it's raining gold, right?
Right, exactly. Mm-hmm. So they'll take a lag during that whole period until they finally get the opportunities they're looking for. Go big on those, and then that's where they make their bread and butter after that.
Yeah, Howard Marks said something interesting about that, about how most great investors are defined more by how many mistakes they don't make than how many great winners they have, and that really reminds me of Buffett, how he's really looking for downside protection first and foremost, and then the upside kind of takes care of itself.
I think, Tom, you did a video pretty recently about like benchmarking and how it totally depends on how, like, you could benchmark someone over 1 year, but who knows what's going to happen in 1 year. Do it over a decade, even that could be potentially misleading depending on what you're looking for. Over 50 years, you might get more of a accurate representation of who was quote unquote better. But it very much depends on the window you're looking at as to who's doing better or worse. And also your investment time horizon, of course.
Yeah, and it depends on your investment goals. Like one of the videos I did, I'm not sure if this is the one you're referring to or not, but it was around like absolute versus relative returns.
That's what it was.
Rather than, and I think, Karan, correct me if I'm wrong, but this is probably more the way you think about the world. You're not necessarily trying to beat an index per se, but focusing on getting above some sort of hurdle rate before you put cash to work. And that's kind of the way someone like Mike Mitchell at Ignore Narrative on Twitter does it. Like, he has this 10% hurdle rate that he wants to hit before deploying any cash into an investment. I think if you take Berkshire Hathaway, for example, like that's, I think, lagged the market for the last 15, 20 years or something now, but the absolute returns have still been pretty good. It's just the fact that the market generally has like screamed upwards that everyone's like, Buffett's lost his touch and Berkshire's now behind. So
can you really be angry at good returns when everyone else is getting great? Like, it's still good returns, Yeah,
it's the whole thing Buffett talks about, like with management compensation. Like, if you make $1 million a year, but the guy sitting next to you made $1.2 million or something, like you're suddenly not happy with your $1 million a year.
Envy.
That's just human nature with everything, not just stocks, but keeping up with the Joneses, as they say. Buy the nicer car because your neighbor has a nicer car, and therefore you can't be outdone by that person. It's very tempting to try and race with other people when it doesn't really serve you in the long term, at least.
I'm curious if you guys do benchmark at all, because personally, like, I do use your hurdle rate as well. I'm looking for a certain return on each investment, and I even use that as a bit of a margin of safety as well. But I compare, the main benchmark I look at is VDHG, which is an ETF here in Australia, a global index pretty much. And I use that because that's where my money would be if I wasn't stock picking. Mm-hmm. So if I can't beat that consistently, then I'm going to put all my money there and take away a lot of time and effort that I spend doing what I'm doing. So in that sense, I think a benchmark's kind of important. Otherwise, we're spending a lot of time that we don't have to.
Yeah, to me, that's a great reason to benchmark. Yeah.
Well, one benchmark I look at, if you can call it a benchmark, is it's inflation. If I'm not beating inflation, then I'm doing something wrong or something like that. Unless everyone is losing to inflation at the same time, which is kind of unlikely. Usually something is going to at least keep pace. So as long as I'm at or above inflation, I know I'm not sinking, Or, of course, like you'll have some years where you're negative, some years where you're positive, but over some few-year term, I'd want to make sure I'm at least keeping up with that. And of course, interest rate on debt, you don't want to be sinking to that as well. You have 5% debt somewhere, better be making more than 5% on your investments over the medium to long term. Otherwise, better pay off that debt. So if you can call that a mark.
I think something that people don't really realize is that Berkshire gets the returns that it does with a lot less risk than the market.
Yeah, that's
so
risk, of course.
Risk-adjusted returns, if you consider those, I think Berkshire destroys the market.
It's like, look how much cash they have. Like, they're not going away. There's like not a chance. Well, there's a chance. There's always a chance for everything, but relative to another company, which is filled to the ears with debt, yeah. Well said, Karan.
Yeah, the issue with risk adjusted is risk is only an issue when bad things happen, right? And it's been so fraught, it's been so great in the markets for so long that people have largely forgotten about risk. And so,
plus it's relative to every person. It's like, well, the risk you see in this company might be different than how I'd weigh it. So it's very hard to just say like, oh, well, risk adjusted, this is better. Well, risk to one person might look different to another person. So it can be hard to kind of communicate that.
Yeah. Hey, do you guys mind if I just make a couple comments on the Ted and Todd thing quickly? I've just been jotting down a few stocks because I think that comment may have originated from a comment that Warren Buffett made a couple of annual meetings back, saying that Ted and Todd had roughly matched the S&P 500 or been slightly behind. And in the last year or so, they've had like one particular stock where they've hit it out of the park. And I'm not familiar with this company at all, but you US guys might be. And that's a company called Dillard's.
Rings a bell.
It does ring a bell.
SRG. When they bought in March. They bought this in March, right? Ted or Todd bought this in March.
Yeah, so maybe, I don't know, Jack, if you want to bring up the Dillard's stock chart, it looks pretty insane. So that was one that either Ted and or Todd smashed out of the park. I guess they were all... They were also, there's things that are hard to measure that they're doing that don't necessarily show up in their portfolio performance, like being the first ones to invest in Apple, for example, before Buffett, and helping Buffett to kind of get his head around that.
It was, I think, Ted Weschler who disclosed a 5% allocation to Dillard's. Yeah, this was right around the time when SRG just came on our radar, and that's why I remember it. Around that time, yeah,
it's like a 7x in a year. It's crazy.
Yeah, why were we messing around with SRG, guys? Look at this.
You could say that about a lot of stocks in the last year. A lot of stuff.
Yep.
You see that little spike at the bottom? I think that is exactly the date that we found out that
right there?
Ted. Yeah,
June
this
5.
was exactly. Yeah. There was disclosed in the news that Ted is someone from Berkshire Hathaway has just disclosed a stake, and the stock kind of jumped.
I mean, there must have been fear about Dillard's declaring bankruptcy or something, because that is quite a drop. I mean, I guess that happened to a lot of retail back in early 2020.
It's actually a little bit. Yeah, I was right as so let's see, what was that? End of February. Yeah, 50% drop, which is about what a lot of companies did during that time. 30 to 50 was kind of the theme of those couple of weeks of March.
Yeah, I believe Ted and Todd also bought Restoration Hardware, which has like been a 6 or 7x as well. So they've had a very good last year or so.
They're doing all right, is what you're trying to say.
Yeah, they're okay. I heard something about that Ted guy's IRA is pretty decent as well.
Yeah, my goodness, all the IRA data.
Yeah,
the leaked IRA data. It's a crime for IRS officials to like give out your personal information on your taxes, obviously. And then ProPublica, who posted all this IRA data, is like, yeah, all right, we'll just make a bunch of articles on it, sure.
Yeah.
So I don't know who leaked it to them, but it's crazy.
Yeah, this is a this is a random aside, but on leaking data, there's a guy in Australia on. I'm not sure if you've seen this, Frank, but there's a guy in Australia on TikTok who I forget which state he's in Australia, but 3 days running, he's come out with the COVID numbers like before they've been announced officially, and he's been kind of making a joke of it, like he'll be drawing on a whiteboard, being like, okay, the circumference of, or the radius of this retirement home is this, like just a bunch of random unrelated information, and then saying, okay, the state's going to have like 79 COVID cases today, and he's nailed it 3 days in a row, and he's just put out a day 4 video, and I'm not sure if they've announced the official numbers yet, but
so you're suspecting he has some private data.
Well, either that or he's been very lucky.
Yeah.
Or he's an incredible forecaster.
Yeah, maybe, you're making fun of his methods.
We should have that guy on the show.
Does he show his DeLorean on TikTok or no? Like, is that on the side?
What's that?
The DeLorean, the car?
No. No.
Okay.
I think this is our peak viewers at the moment, boys.
Yeah, we're at 60
live
I
viewers.
think our highest was like
compounding.
40 something. So you guys like our you guys like the best ideas. So
Yeah,
we
you guys are
this.
suckers for the best ideas.
Good
I know
idea.
Hit the
how-
like button while you're there.
If you like this sort of content, don't only smash the like button, do that first, but then hit the subscribe button as well, because we'll be doing more stuff like this in the future. That's for sure.
Boys, guys, we may even hit double digits for ad revenue between the 5 of us this week.
Yeah. It's a making moves. We'll be able to pay the StreamYard fee, which is our streaming software, which
Yes.
allows us to pull up comments like this. Trying to get one more question in before we wrap up today, tonight, this morning, wherever you are from the world,
Right.
our beautiful worldwide audience.
Where is everyone watching from? Do share it in the chat. That'll be nice.
We had that contest a while back, but we got a couple hundred new subscribers since we did that contest. We're up over almost at 1,400. So love the
We should do another
compounding growth.
giveaway. Yeah, we should do another giveaway at 2,000.
We
Yeah,
should, yes.
We should
We'll do
also.
a punch card brew. Yeah.
Yes, let's do that.
Did you guys get it or not yet?
Mhm.
I did. I got
Did you
mine.
did you send me one, Karan, or not?
I did.
Oh yeah, no, I haven't got that yet.
Must be in the post.
Everyone,
Yeah.
check out Karan's merch. We have some punch card merch in the description below. Shameless Cloners, punch card brew. You got the Spackman.
Do you have a link to the merch, Jack, for people?
It's in the description below.
Oh, it's in
so
the
go check it out.
description. Okay,
Nice and easy for you guys to check that out.
beautiful.
And
I'm looking forward to a punch card brew. I see Brad and Frank always drinking out of jars in these streams. What's that about?
the mason jars. We've gotten comments about that before.
It's a classy look, Frank.
It's very manly. I like it.
Yeah, simple. We're trying to keep it simple and cheap, so we can put our money into stocks instead of glassware.
Reduce, reuse, recycle are those things.
I guess we can make the last question sort of selfishly about debt pay down. So he's asking, after dinner investors asking me about paying off mortgages early on a primary home, stupid or smart. I mean, first off, you can never say it's stupid to pay down debt, even if it's really low interest, because it's very hard to put a tangible value on like the freedom, the liberation of not having payments. So
Sleeping at night.
Exactly. So whatever that is worth to you, that's the big consideration. But I mean, beyond homes, just paying down debt in general. Do you guys have any significant debt? I certainly do. And if it's low interest, fixed rate, extended over 30 years, that's a lot more attractive than, say, a variable rate loan that currently is at a very low interest rate, but you have the interest rate risk. So the way I prioritize it in my head is, one, anything high interest. So if you have credit cards, or by God, please pay those off immediately. You have higher interest debt, maybe over, say, 7-8%, because it's going to be pretty hard to get beyond that in a return anyways. So you might as well pay that off, most likely, at least in this environment. And then below that, it's very much like, all right, how extended out is this loan? What asset do I have an asset that's paying this down, so it's not just coming out of my active income? That's kind of the way I look at it. Yeah. So what are you guys' thoughts on debt? Does it play a big role in your portfolio? Any role at all, or are you steering clear?
Well, this is something I'm thinking about at the moment. So my current situation, the only debt I have is a small amount of student loan left over, but New Zealand has completely interest-free student loans, so I'm not paying that down any faster than I need to. But yeah, I'll be buying a house within the next few months, hopefully. So it's something I'm thinking about more. And the longest period of time we can lock our interest rates in for is 5 years. So it's quite a different situation to
Very
the
different equation.
30-year fixed rate. Yeah.
Yeah. Thank you, government subsidies and Federal Reserve paying for these subsidized mortgages.
Yeah.
Take advantage of them while I can. That's my goal. What about the rest of us?
I'm in pretty much the exact same position as Tom. I think we're both getting close to probably looking for a house. Tom probably sooner than I. But the only large amount of debt I'll ever take on is probably that house loan. Otherwise, I'd be any other small amounts of debt, particularly with high interest rates, I'd want to pay off as quick as possible. I've had a credit card in the past, decided that was a bad idea. I've got a car loan actually that I regret a lot, but I didn't want to. I would have had to sell stocks otherwise. So,
that's tough.
What do car loan terms look like?
What's the rate on your loan, Frank?
Yeah,
it's a 5-year term, 4% or so, I think,
Okay,
4 to 5%.
That's about the same as many U.S. loans. It's usually 5 to 7 years, I think, is most common. That's one thing with obviously with stocks. It's very different than if you're buying a rental property that's bringing in monthly income. It's a lot easier to maintain debt with that, whereas with a stock that, even if it's a dividend stock, might not pay. It'll pay quarterly or something like that. So it's not really useful for paying down debt, because if you have monthly obligations to pay, then you might have to dip into the actual asset value, and that's no fun. So it does kind of depend on the asset that you're working with. So if you have like a stock portfolio focused on intercompany growth, where you don't want the dividends, if they have a really high return on invested capital, for example, you don't want dividends. You want that company to keep investing in itself. So therefore, it's not very sustainable to have a bunch of debt payments that you have to meet on the other end.
And then a car loan is probably one of the worst debts you could take out, because it's a depreciating asset, obviously. So I did always say I would never do that, but I got to the point where I didn't have much choice.
I'll say that's debatable. It depends on what the car's for. If it's just a toy that, or like it's not really that necessary, then yeah, I would totally agree.
Yeah, your Ferrari, you can't take out a car loan on your Ferrari.
Yeah, right. But if it's something that's producing you a quote unquote return because it's getting you to work or doing whatever, then why lock up your money in the car if you're making income at your job anyways, and keep that invested? It's very much depends on the situation, even though it is a depreciating asset, as long as you pay that thing off eventually.
Thanks, Jack. You make me feel better about my bad debt.
It can be bad. It can be okay. I'll never call it good, but it can be okay.
The credit card situation is also very different in New Zealand and Australia than the US. Like, my understanding is you guys have the advantage of like building up a credit history and stuff like by using credit cards. But when I go and get a mortgage, I have a credit card, but it's only got like a $2,000 limit on it. But they consider that debt, so they would treat it as if my student loan is $2,000 higher than it is. So you're better off to be like a debit card guy.
I mean, that kind of makes sense, because it's like,
it sounds more rational to me. But
I don't know. But to actually charge it on you, I don't know.
Yeah. I think
but both are kind of goofy.
Jack, a recent video about bank churning and credit cards, that also applies, like the whole points
huge.
and everything that you get.
It's only for points. Like, I would never use the credit cards to like invest, because it's nuts. They're 20% interest. Like, good luck. Like, yeah, maybe I'll find something like that that's reliably giving me 20%, but that's like the 1 in 10 that you're hoping for, like a 20% per year immediately that you can use to pay down the credit card. That's something that can take a while to find.
Yeah.
Give me those reward points though.
Brad and Karan, what are you guys up to with debt, if you don't mind sharing?
I don't have any earth-shattering thoughts on real estate debt. It's really about opportunity cost to me. So just making that assessment,
right?
Given the current environment.
Are you guys familiar with Dave Ramsey?
Yep.
Yeah.
Mhm.
So I
I'm
I
also
do like what he. Yeah.
I was going to say I'm also familiar with Ramsey the cat, named after Dave.
Yeah.
Is
Over
it?
on that's over on Graham Stephan's channel. For
Graham
those-
Stephan
Oh.
named his cat after Dave Ramsey.
for
Sorry,
those
Graham, go on.
deep into the YouTube finance game.
Yeah, just that I like his thoughts about debt and how, kind of go about that way.
Cool.
Extreme no debt. It's hard to argue against it, like I kind of let off with. It depends on your situation. If it makes sense to get rid of that debt, it's very liberating, and no one's gonna. If you paid off your home early or paid off whatever early, is someone really going to be like, oh well, you could have got an extra 5% here? Like, you don't have any debt anymore. Like, that's totally great for you. And if you want to take out more debt again, you always could. So that's why I kind of look at it. If you were to pay it off early, especially for something like a revolving loan, just go take it out again if you really want it back.
Yeah, debt can be a slippery slope. How many of you have read Confessions of an Economic Hitman?
That's a book wreck right there.
It'll blow your mind. So
All
check
right,
it out.
we'll leave it on that.
Let's leave it there.
Brad's got a couple
We've
good
got a-
ideas today.
Can we just shout out some of the different locations people are tuning in from?
Yeah.
But that was
We
really
got,
good.
we got a good global
Style.
spread.
We do.
Jason is very cold by the looks of it. Sorry.
Borneo,
Borneo, Singapore.
Singapore. Yeah, I don't know about that one.
I'm skeptical about
Toronto, Mexico,
We're going global, boys.
Texas.
that. Yes.
It's a nice suit, Brian.
We got and we got New
Calm
Zealand there.
downtown.
That wasn't included. Hamilton. And
SC's from Compound Town.
yeah.
You guys ever been there? Or?
I need to go. I think I'm going to buy a
Working
house
on it.
there.
Oh, hey, good call, Jesse Karan. You should make a punch card mason jar. That'd be fantastic.
Brilliant. More merch.
I like the pint glass better, like it looks. Yeah, if you guys have it.
Major
Iceland
branding
would be mine,
opportunity here.
so.
Punch cards
Yeah.
right across here.
Bunch.
This
Once
is a
those all
repurposed
arrive.
peanut butter jar, my friends. Peanut butter jar.
Nice.
That's thrifty right there.
Yep,
That is
that's what I'm
thrifty.
talking about.
It's dedication to the mason jars, boys.
What on earth? What do you
I heard mason jars improve your rate of beard growth as well.
That's why. That's it.
Once we all get the punch card brew glasses, we should all have a beer on here. Although it might be too early in the morning for some. For Karan, maybe, I don't know.
I have a confession, guys.
It's
We'll
never
make it
too
work.
early.
I have a
It's never
confession.
too early.
I'll have
You
a
don't
glass
actually-
of water.
I don't actually drink water.
Oh, we've got straight edge Jack over here.
Yeah.
Non-alcoholic,
Yeah,
non-alcoholic
having-
beer. We can do
Having a
that.
beer is just an expression, Jack. That's
Yeah, maybe. Anyways, this has been great, guys. Lots of good ideas here. Brad, I'm going deep into that.
Please do. Let me know what you figure
Yeah.
out.
As a real estate guy myself, FRP, right? Yeah, FRP. I'm going in that one. That's enticing.
Sweet.
But otherwise, until next time, everyone. For anyone who's stuck around to the end of the show, thank you. We're almost at an hour 20 here, one of our longer shows. So might as well smash the like button if you haven't already, and the subscribe button. Check out the Discord in the description below. That is free, no obligation. Just come on in and we can talk about value investing things there as well. But otherwise, we'll see everyone next week.